Welcome to Navigating Now, real talk for rocky times. A Pete the Planner CalmCast.
Good Tuesday to you. It's Peter Dunn, Pete the Planner, CEO of Your Money Line. It is good to be with you on this Tuesday. I believe it's April 22nd. We'll go with April 22nd. Oddly enough, a lot has happened since we last spoke on Thursday. Of course, this here, Navigating Now
CalmCast
is a 10-minute look of what is going on in these wild economic times we live in. Today, we're going to cover three very specific topics. We're going to hit bull and bear markets, help you understand what they are and what you should actually know about them. We're going to talk about one of my strangely favorite topics, which is the jobs report. And then we're going to talk about the best financial metric of all time. And I only feel that way because I created it. And I love it too. It's called Power Percentage. We're going to talk about that. But here is what's happened since the last time we spoke on Thursday of last week. I said to you, volatility's calmed down a little bit for now. And it had. But now it's wild again. Yesterday was about 1,000-point swing in the Dow. Today, things are picked up a little bit, but it's all under this idea that President Trump is talking about firing the chairman of the Federal Reserve, and that is Jerome Powell. And then that would create a lot of instability. So there's some challenges there. Some new student loan information came out, and that student loan information is this. If you're in default, your wages may be garnished, and they may be coming after those payments. If you ever have any questions on that, if you're your Money Line participant, if you are covered, if you have an employee benefit via Your Money Line, which is our company, by all means, just give us a call. We'll walk you through that. All right, so here's what we're doing today, bulls and bears. Here's how I like to think about it, okay? And so oddly enough, when we talk about the market, we talk about it in this animalistic way. We say, when things are really good, it's like a bull charging aggressively. Okay, so I don't know what's the running of the bulls in Pamplona. Am I even saying that right? In Spain, maybe it feels like the right thing in my head, but it's just the market's going forward, and it's when it comes 20% higher than a recent low, and it's sustained for at least 2 months. Truth be told, we're coming off a multi-year bear market. Arguably, if you ignore the 148-day blip that was 2020, we're coming off of like a, 15-year bull market, meaning that things are really good and aggressive. So when you hear bull market, that means the market is good. It's going up in value, and you have a lot of unrealized gains in your accounts. Okay, bulls are good. Here's how I used to remember this. Back when the Chicago Bulls were really good under Michael Jordan, I'd always remember, well, the Bulls are good, so that means things are good. And at that time, the Chicago Bears were not that good. And so it falls apart if the teams get better or worse. Needless to say, a bear market is when things are bad. Here's how I think about that. Okay, let's see a bear walks out of its cave, because bears have caves, apparently. I don't know where all these caves are, but they're bears and there's caves. And they walk out of their cave and they see what's going on. Things look uncertain, so they just go back into their cave, meaning things are not good. Okay, so a bear market is bad. It means that stocks have fallen off of their high by 20% or more. So we've been teetering around a bear market right now. A bull market and a bear market are both sustainable things, meaning that they go over a period of time. It's not like we go into bull and bear markets every other day, which is important because we learned about volatility here in the last couple of weeks. We'd be swinging in and out of bull and bear markets every single day, but that's not exactly how it works. Okay, so now you know, bull's good, bear's bad, and it's sustainable over a period of time. Now let's talk about the jobs report, which I find to be absolutely fascinating. Here's why. At the end of every month, we get the jobs report from the previous month that say, hey, how'd things go last month? Are people hiring? Are people laying off? What's happening? And the jobs report for this last March was supposed to come in at like 138,000 new jobs created. And it actually came in at 228,000 new jobs. Now, that's significantly important because, well, it's a lot more. But the challenge is the jobs report is considered a lagging indicator. That is to say, it tells a story of what has already happened, not what is currently happening or what is going to happen. So when jobs are created, when jobs are posted and planned for, and interviews and hires and all the things take place, they happen over a period of months, right? And so by the time the jobs report comes out, because someone got hired in the previous month, that was all based on economic data that it persisted and existed in that moment. What a jobs report isn't is a forward-looking thing saying, well, we think things are going to be really good in the future. Now, here's why this really matters. If you think about the times we're living in right now, and you think about April 2nd, which wasn't March by definition, April 2nd was Liberation Day. That was the time when President Trump came on the lawn of the White House and said, we're going to have all these tariffs. So that's when things kind of went off the rails with the economy. So expect the jobs report, which will come out, the first or second day of May. Expect to see the jobs report sort of mixed up because it really helps us understand what is going to happen going forward. Okay. Again, in these strange economic times we live in, this is a great opportunity to start to try to understand all the terms you hear out on the news or on a podcast or you happen to read on the internet. That's the entire point of Navigating Now.
CalmCast.
That's right. Okay, now let's talk about my favorite financial metric of all time. Years and years ago, I was talking to a friend, and yes, I have friends, especially years ago I did. And my friend just said to me, what is the absolute best way to understand if I'm making good financial decisions on a regular basis and be able to measure those decisions? Well, that's an incredible question, right? Because what it's saying is, am I stable? Am I stable on an ongoing basis and making decisions that prove that? So I got pen to paper. I think you went keys to computer, but I created this concept called power percentage. It measures what percentage of your income goes towards increasing your net worth every single month. Okay? You get paid, and with that payment, you can consume things, buy things, exchange your money for those things. Now you have things, but your net worth doesn't really go up. You could invest the money. You could pay down debt. You could save the money. So there are different ways to make your net worth go up every single month. And so power percentage measures that. If your employer covers you via your money line as an employee benefit, just go to your account and you can calculate your power percentage right online, and it is a good thing to do. But here's the long and short of it. If less than 10% of your income, your gross income, meaning pre-tax income, if less than 10% of your income is going towards improving your net worth, then you're struggling very badly financially, okay? Sometimes that's tough to hear. I don't know, but here's what that means. Let's say you make $5,000 a month. Just picking a number. Don't get upset about it. If $500 a month or less is going to improve your net worth on a regular basis via a 401k deposit, and I'll even include what your employer matches. If your employer matches, great. I'll count it towards your power percentage. The amount of principal on your mortgage is paid down. That gets included in that number. Will you put in your savings account? If you happen to have consumer debt, I'll include that. I will not include car payments. I'm sorry. I will not include car payments. But what it does is it helps you understand how dependable you are on your current income. You will someday be able to stop working. And boy, will that be great for you. And you'll be able to do so when you are not so dependent on the income that you're currently earning. Think of it this way. If you're dependent on 99% of the income you earn, then that means you're only independent of 1%. Your power percentage helps sniff that out. At some point in time, it says you're only dependent on 65% of your income because your power percentage is 35%, which means you may be able to offboard your income's responsibility from your working income to your retirement income. All right, that's it. Bulls and bears, jobs report, and power percentage. Here's what we're talking about on Thursday, earnings season. And boy, it's earnings season. So appropriate conversation. When we talk about what do earnings tell us in the market, we're going to talk about wage growth and then the old percentage or the old adage, pay yourself first. All that is on the next Navigating Now.
CalmCast.
I'm Pete the Planner. I'll see you later.